Since Donald Trump became president, European stocks have been beating American stocks. Many European investors are asking, should we dump American stocks and invest in Europe instead? Even though I started my career on Wall Street in America, I've spent most of it here in Europe, including my time as CEO of a European investment company which today manages over 1 billion euros. I've been investing a lot of my family's wealth in American stocks for years. Let me explain what I'm doing going forward and why. So, the situation with American stocks is a bit crazy right now. The US has only 25% of the world's GDP, but the American stock market makes up over 60% of the global market by size. And on top of that, many Europeans seem to think that investing means buying the S&P 500, the famous index which lists 500 of the biggest American companies. Is this justified, or is it a problem? Well, there are three major reasons why Europeans have invested so much in America. The first is historical profit levels. According to the famous book called Triumph of the Optimists by Professors Staunton, Marsh, and Dimson, U.S. stocks earned 6.7% per year over the 20th century after adjusting for inflation, compared to 5.2% per year for global stocks. And this is a massive difference when compounded over time. $1 would have become over $700 invested in the American market over the full century, as opposed to around $160 invested in non-US markets. Now, the second reason is the legend of American capitalism. If you grew up watching American movies and reading American books like me, you didn't just learn to love cowboy hats, Cadillacs, and roadside diners, you also bought into the myth of the unstoppable American entrepreneur. I've heard even professional investors tell me that America is the best place to invest because America treats investors and entrepreneurs the best. And to be fair, historically, there's been a good amount of truth to this. Now, the third reason for investing in America has been that the biggest global corporations are primarily listed on American stock exchanges. It's a bit like when you move out of your parents' apartment for college, but still list their home address on all your bank accounts and everything. For example, many S&P 500 companies make half or even more of their revenue from foreign sources, but they count as part of the US stock market. So, arguably, investors in American stocks have actually been making quite a diversified global investment. These three reasons have motivated European investors to put their money into American stocks for decades. But are they still valid in 2025, in the middle of a Trump presidency, which has started with a trade war and open antagonism between America and pretty much everybody else in the world? First, let's look at historical profits. Sure, American stocks have outperformed Europe historically, but when you look at the details, you notice that European stocks actually did a little better than American stocks between 1970 and 2010. All the US outperformance happened over the past 15 years. And what else happened over the past 15 years? Well, American stocks became a lot more expensive. Let me explain what that means. So one of the key metrics that investors use to judge stock prices is the price-earnings ratio. Think of it like a stock thermometer for estimating how hot, how pricey a stock is. You take the stock price and you divide it by the stock's earnings per share. For example, if a company's stock price is $40 and the company had profits of $2 per share, the PE ratio is 40 divided by 2, that's 20. A higher PE ratio means that you have to pay more to buy the same level of company profits, and a lower PE ratio means you can buy stocks more cheaply. Now, here's a picture of PE ratios in America and in Europe today. And as you can see, over the past 15 years since 2010, American PE ratios, American stock prices have shot up into the sky. They are now at one of the highest levels historically, while in Europe, valuations have remained much lower. To be clear, a PE ratio is not a reliable predictor of future profits. But as a general rule, higher PE ratios have been linked to lower investment profits going forward. For example, this paper from Vanguard suggests PE ratios explain about 40% of stock return differences over time. So, while US stocks have had fantastic returns historically, at least by this metric, by looking at how expensive stocks are, Europe could easily have the upper hand going forward. And that's especially true when you consider the second factor, which is the legend of American capitalism and how it seems to be cracking, if not collapsing, in 2025. Historically, capitalism has succeeded the best, economic growth has been the strongest in countries with a strong rule of law and low levels of corruption. Now, I don't want to get into politics, so I will let you draw your own conclusions about how America is doing on that front today. Plus, America is saddled with high government debt, crumbling public infrastructure, a failing healthcare system, a nationwide drug and homelessness crisis, a draconian deportation policy which is pushing up labor costs, and more. Now, to be clear, all countries in the world have problems, but American capitalism does seem to be more vulnerable today than in the past. And this could also affect the third factor, which is most global corporations choosing America and the American stock market as their base. With America waging a trade war and the world becoming multipolar, we could easily see more companies preferring Europe or Asia or Canada or Australia for their bases. Given these three factors, it's not surprising that many investors are looking at European stocks as an attractive alternative. And that's before you even look at reasons to be optimistic about Europe, such as Europe pulling together in face of the Ukraine war and the Trump presidency, the massive investments being made into the European defense sector, and the growing calls to deregulate and simplify the European business environment. Looking at all this, does it make sense to invest in European stocks? And if so, what is the easiest way to do so? Well, let me explain exactly that. But first, here's a quick note. I've noticed that only around 24% of the people who view my channel are subscribers. Now, when you subscribe, you not only get notified about new videos, you also really help us grow and reach new people. So if you'd like to help, hit the subscribe button and let's keep going. So, is investing in European stocks a good idea? Well, yes. I think it's a perfectly sensible choice. Europe is a large, wealthy, diversified market with many different countries and industries represented. Stock prices are reasonable and there's plenty of upside. Plus, it's easier to do this than it ever has before. With a good European stock ETF or index fund, all it takes is a few clicks. So for example, if you wanted to find such an ETF, you could just go to justetf.com, you could click on equity, that means stocks, and under region, you could select Europe, and you've got over 300 different European stock ETFs to choose from. Now, to be clear, this is not an investment recommendation in your particular situation, but if you do decide to invest in European stocks, ETFs like this make it easy. Before you jump in, though, here are 3 reasons why abandoning America and putting all your money in Europe alone might not be the smartest choice. First, remember what Warren Buffett said, never bet against America. This is a country of 340 million people who are taught from childhood to have a go-getter, money-making mindset. This country has tremendous natural resources and, despite all the damage Trump may have done, a deep well of immigrant talent. Many of the smartest and most ambitious people in the world have come to America to try and make their dreams come true. Plus, most of the world's leading tech and AI companies are still based in America. And if the AI revolution becomes as dramatic, as transformative as I fully expect it will, this is going to be a tremendous wealth explosion like we haven't seen in a long time. America has had many dark moments in the past. The Great Depression, the stagflation of the 70s, the dot-com bubble, the Great Recession. But it has always come through in the end. A second reason to be cautious about putting everything into Europe is, well, I'm European, I'm proud of Europe, but when it comes to our continent successfully deregulating and becoming super business friendly, let's just say I'm not holding my breath. Having had some experience as a small business owner, trying to do business across Europe and navigate EU directives and regulations and the different political factions in different countries, I have to admit I'm not terribly optimistic. And the third reason I'm cautious about betting everything on Europe is this. I love a free lunch. And according to Nobel Prize winner Harry Markowitz, diversification is the only free lunch in investing. It is the only way to improve expected returns while reducing risk. Overall, I'm quite optimistic about the future of humanity, but I'm not sure how exactly we will get to the bright future that's ahead of us. Will it be Europe or America or Canada or Australia or Japan or China or India leading the way? Instead of betting on just one region, on just Europe to do great, I would prefer to diversify globally. And this brings me to two evidence-backed strategies to consider. The first is the most classic passive investing strategy, the vanilla ice cream of the investment world. And this would be to invest in a global stock ETF or index fund. This way, your money will get distributed all over the world according to the market capitalization, to the size of each country's stock market. Historically, this has been a really reliable way to invest. It spreads your money very widely and you benefit from the global economy. This is also the strategy that I use for investing my family's wealth. I use a couple of global ETFs which invest in small, mid-sized, and large companies all over the world. Now, this approach does have a potential drawback. You are still investing 60 to 70% of your portfolio in American stocks. So if you are really against it, there is a second alternative, which is also supported by data. You can overweight Europe, put maybe 30 to 40% of your portfolio in European stocks. This is called having a home bias, investing more closer to home. And it can make sense for a few different reasons. For example, there have been some cases historically where countries confiscate the investments of foreigners. And that seems less of a risk when investing closer to home in European countries. Plus, you are limiting your currency risk, especially if you are based in the Eurozone. So, if you put 30 to 40% of your portfolio in Europe and the rest in a diversified global portfolio, that is also an approach that's well supported by evidence. It's not my personal strategy, but I think it's a perfectly sensible choice. And you can easily implement it by combining a global stock ETF with a European ETF in your portfolio. Just keep in mind that global ETFs already invest part of their money in Europe, so you need to take that into account when calculating your ideal portfolio allocations. Now, if you're new to investing here in Europe, figuring out details like this can be a bit tricky. You might have questions like which ETFs or index funds to buy, how to balance your portfolio, and how to navigate difficult times in the market like we have today. If that sounds familiar, you might want to watch a detailed training that I put together for European ETF investors. Check out the first link in the description.